Emkay Global Financial Services, who joins in now. Nirav, hi, welcome to the show. If you could just give us a sense in terms of what you are estimating for FY23, because you are anticipating the Nifty to probably inch up towards the end of FY23. You have a Nifty target of around 19,000. But what would be the journey to that?
Right. So first of all, let's keep in mind that despite the kind of problem we've got on the geopolitical side, and which then filters onto the commodities, the actual impact on earnings of the Nifty is not significant, and that is because that is the structure of the Nifty index in the country. So you lose quite a bit in autos and cement and consumers. But you can disproportionately in terms of energy, commodities, to some extent, even software. So the earnings outlook seems to be fairly steady. Obviously, we are not looking at a Six Sigma event where your economic collapse goes down by, instead of growing at 8%, starts growing at 6% or something thereabouts. And we assume that in the next 6 months, probably we'll see some sort of resolution to what is happening to Russia-Ukraine. We are still penciling in about 20% earnings growth in FY23, which will be followed by about 15% growth in FY24. So that remains our basic enabler for looking at a 10% growth in Nifty from the current levels, which gives you roughly 19,000 Nifty, and this will be back-ended.
Mr. Sheth, good afternoon. So as Ekta was mentioning, the journey to that 19,000 mark, which sectors or which stocks do you think will contribute to that move that we are seeing? You did mention some of the commodity names. Do you think there will be some other sectors which will also have some contributing factor here?
Yeah, absolutely. So commodities will do well, but obviously I worry about the quality of earnings. They are not steady compounders, and therefore there are valuation challenges to commodity sectors. But outside that, obviously, which is a consensus view, and we are talking about the banking sector, very high visibility on earnings, right? Because you probably have seen bulk of this credit loss behind you. You are still carrying provisions for COVID now, which seems to be there is a high probability that those provisions could be returned back. I think the market is probably looking at some line of sight on the pickup in credit growth. If that happens, then you will see, I think a lot of the stocks are trading below their fair value or intrinsic value. And we expect that to be a big contributor, banks. Secondly, let's look at auto. Everything that could have gone wrong with auto has gone wrong. So you started with semiconductor supply shortages, commodities, petrol prices, diesel prices, cost of ownership issues, right? These are obviously problematic for your 6 months outlook. But when you start looking at FY24, I think, which is what we start discounting in the second half of FY23, the outlook for consumer discretionary, including auto, looks extremely good. So these are primary overweight sectors.
Okay, all right. Those are your overweight sectors at this point. What would you probably not touch in that journey towards 19,000? As well as what do you think is the biggest risk factor for the markets and for your target?
Absolutely. So I think I'll answer the latter question first. The risk is obviously, I don't know what is the quick resolution to this Russia-Ukraine issue. And the reason I'm saying this is a good scenario is one where, you probably have either you give a golden bridge to Mr. Putin to climb down, or he's probably taken out in some sort of coup. None of them seems likely at this point of time, right? So even if you assume that the war drags on without making too much of headline news, you don't know what could lead to unwinding of the sanctions, right? Therefore, you are likely to be in a world where commodity prices are going to be higher for longer. And right now, what you're looking at it are simply the ticker prices, right? It takes time for this to start filtering into the economy, and the second and the third order impact that happens, right? So that is first thing, right? That we completely miss in terms of the long-term or the medium-term impact of high energy and high commodity prices on the economic growth rate and outlook on the margins as well. Secondly, this simply increases the chances of policy risk. We don't know, how are you going to react to higher inflation or expectations because of supply shocks. This is not an aggregate demand issue. When you look at something like US, that economy is firing, right? UK, the economies are firing. Their PMI indices are at 60 plus, 58, 59. We don't have such a strong backdrop for economy in India, right? Which probably therefore increases the risk of a tightening monetary policy. So I would say that these are two primary risk factors that I think we need to watch out for in FY23.
All right. Okay, Mr. Sheth, thanks a lot for joining us and taking us through the market fundamentals and your outlook as far as the Nifty is concerned. It was a pleasure speaking with you.